Chris Jackson, steel market researcher at MEPS International. It's great to have you back on the Speaking of Steel podcast, this time for an episode of Marketing Minutes. How are you doing? Happy to be back?
Yeah, very well, Tom. Yeah, thank you for the invitation once again. Yeah, it'll be great to also have a chat and share the latest insights. So, yeah, thank you for the invitation.
Great stuff. Well, I know you're really well briefed. The Marketing Minutes this time will draw from research conducted for the International Steel Review that MEPS produce, and it results from research conducted throughout the month. So your focus is going to be at Central Europe. You're going to give us a snapshot of the market there. As we've seen across many markets, steel prices are very much under pressure at the moment, demand at a low ebb in so many places. I got the feeling there was a slight air of optimism in Central Europe, something to get hold of. Can you sort of give me an indication as to what demand is like, and has that actually manifested itself?
Yeah. As you said, Tom, very, very interesting time. I think the Central European market is somewhat at a crossroads. I think what you mentioned there in terms of low demand, poor market sentiment certainly rings true, but certainly maybe comes a comfort or light at the end of the tunnel in regards to more headline, more general statistics, which are indicating better times ahead, potentially, and certainly gives maybe an opportunity for maybe certain steel using segments to maybe benefit from that. I think at the moment you probably get two ends of the scale where maybe the numbers are not always corresponding to the reality. Certainly from talking to research partners in September, there was a feeling that market sentiment remains negative, volumes remain low. Certainly from a stockholder perspective, there was a feeling that many stockholders were still working on a hand-to-mouth basis, maybe only buying what they need, certainly not buying for stock and keeping their volumes quite low. And typically from a lot of our calls, there was evidence that the steel manufacturers were in some instances bypassing the stockists and targeting end users directly, looking for high value niche orders. So on the surface, you get the feeling that market demands in terms of order intake, order inquiries are certainly weaker than anticipated, and the pickup following the summer period has been very limited at this stage. In terms of end user activity, there has been a mixed picture. I think the yellow goods and the white goods sectors continue to struggle in the main. In terms of the automotive sector, we hear in Poland that maybe there are, again, production volumes and sales volumes are slightly lower than people would want. But an exception to the rule is the Czech car making sector, which in the main continues to perform quite well. Skoda Auto do have the luxury of being able to produce all types of cars on the same production line, and that is certainly helping the sales of their electric car models, as well as maybe the sales of hybrid or combustion cars to the rest of the world as well. So they're certainly getting the benefits of that, and they're certainly one of the performing other areas of the Volkswagen Group at the moment. And interestingly, Toyota have pledged a significant investment in their central Bohemian plant for a battery electric vehicle. So again, tentative signs there that the sector is holding up well, with obviously some longer term prospects as well. I think a key factor as well in terms of steel demand is in terms of order intake, general level of inquiries and sentiment is maybe there's a short focus on Germany. I know the German market is very key for those steel companies who certainly who are based in the neighbouring countries who are looking to export, and I think it's fair to say that steel exports to Germany are down and in associated industries, and in turn, because the German market is still in a weak position, you're finding that the German service centres, maybe as well as some of those around Europe, are targeting Poland, Czechia and neighbouring countries for additional sales to sell surplus stock, and that seems to be a symptom that a lot of stockholders are dealing with. So it's interesting you mentioned there in the opening that obviously that is one perspective, but there is an alternative perspective, like you said, that maybe a few of the indicators, the economic indicators are given a little bit of a carrot that there may be better times ahead.
I guess defence is playing a large part in that as well.
Yeah, I think interestingly, in some areas it could be argued that Poland is probably one of the rapidly growing countries if you look in terms of GDP. I know the GDP measure was 3.4% for Q2 this year on a year-on-year basis, which again stacks up very well compared to other continental countries. And the projections for 2026 and 2027 are also over 3% as well, which is, again, on the surface, very encouraging.
Impressive, yeah.
I think what we'd say with that is, like you mentioned, this seems to be centred predominantly on a couple of sectors. I think it's natural that there is a short focus on the military and defence segment, obviously because of the geopolitical situation in neighbouring Ukraine, but obviously the pledge of Poland and other European countries to ramp up their defence spending, and interestingly their draft budget for next year is 4.8%, which is again
GDP.
percent of GDP, which
Yeah.
is the largest pledge in the NATO group. So naturally there is a keen eye on military and defence, and we're also seeing a few developments in the energy segment as well, where I believe two nuclear reactors have been given the go ahead, and in Poland particularly, there's a little bit of a focus on offshore wind, with Poland becoming a little bit of a regional hub for green energy. So military and energy aside, maybe two sectors that you associate with medium to longer term projects. So I think from what I mentioned earlier, maybe a lot of companies involved with commercial sales, day-to-day spot business, and not reaping the rewards that the numbers indicate. But certainly the companies involved with those two industries will be maybe whet the appetite of better times ahead, and maybe gives cause for optimism, not just for next year, but for the years to come.
So there's a slight mismatch there between spot and contract. I'm getting a feeling from what you're saying there, but I guess supply at the moment is probably outstripping demand, is it? There's been a lot of movement with mills in that region, hasn't there?
Yeah.
So what's the supply picture like?
Yeah, that's a very true assessment, Tom. I think, again, speaking to market respondents in that part of the world, I know there is a feeling that, again, on the surface, that maybe steel buying options are fairly limited. It's been very well documented about the problems with the Liberty Group, based both in Galati in Romania, but also Dunafer in Hungary. It's come to our attention that the likes of ArcelorMittal, US Steel, Kasici as well, are maybe limiting the capacity that they make available for spot customers. Obviously, that does lend itself to when they're pushing their pricing ambitions, and again gives them an opportunity to redress or rebalance supply with current market demands as well. So, as we mentioned earlier, a lot of companies are working on a hand-to-mouth basis, and they're able to do that because the mills are able to deliver flexibly and at short notice. And we're seeing for maybe coil products, maybe lead times of 4 to 6 weeks, a little bit shorter for long products, which again is not untypical. And again, a lot of Polish and Czech buyers do have the option of either buying long products from mill stocks or the next available rolling, which tends to commence on a 2 or 3 week basis as well. The one exception to the rule may be hot roll plate. The lead times are slightly extended there. The re-emergence of Huta Częstochowa in Poland has been a welcome development for plate buyers, not just in Poland but also in the Baltic nations as well, and they have certainly increased their capacity to what we believe is around 40,000 tons per month. Again, quite shy of their full potential, but we do believe that they are currently producing on a on a basis where they are trying to minimise energy costs and maybe looking at manufacturing what they need in non-peak rates or costs in terms of electricity and other energy costs as well. So in terms of Chesterova, working at maybe a ramped up rate, but obviously below their potential, and we believe Vitkovici Steel in Czechia, that their lead times are similar to Chesterova, around 8 weeks, and they again have maybe had, we believe, maybe one or two issues with regards to slab procurement, which has slightly delayed their offering. So again, plate is maybe an exception to the rule where the lead times are slightly longer than maybe what you find on other products. Interestingly, not just looking at the local regional scene, but imports are very influential as well. More so for Poland for geographical logistical reasons than Czechia. But certainly in the Polish market, we were aware that Ukrainian imports are readily available. Obviously, because of the current situation, export channels for Ukraine are very limited. The logistic routes are obviously very problematic. So we believe that material for coil, sheets and long products as well is being delivered to the Polish border. And again, Polish buyers have the opportunity, maybe at a slight price advantage, to purchase Ukrainian material at the expense of as an alternative as well. So that is one consideration. And obviously, like the rest of Europe, buyers are now analysing their procurement decisions in light of CBAM and what we believe may be, albeit unconfirmed yet, changes to the safeguard quota system as well. So again, procurement is becoming an issue. Interestingly, the customs clearance has just passed for the 1st of October, so we believe a lot of material will be coming into European ports. Customs cleared the beginning of this month, and that will work its way through the supply chains now. But obviously for imports coming from outside of Europe starting from January 26, it will come with a heightened risk in terms of likely changes to the safeguard quotas at some point during 2026, and also CBAM considerations, where it's fair to say a lot of purchasing managers do have still a level of uncertainty with regards to the actual true costs involved with bringing imports from outside of Europe.
Absolutely. Great insight there, Chris. I mean, a large part of the offering that we provide through the International Steel Review is the forecast. While we don't want to give everything away in the podcast, can you give us a little insight into perhaps the outlook in the months ahead for Central Europe?
Yeah. I mean, in terms of the pricing situation, I think certainly starting with coil products, we've noted over the last month or two that there has been a slight upward trend in prices. I think prices generally reached their lowest level in July. The likes of ArcelorMittal and other steel manufacturers were in an attempt to improve their profit margins, obviously having one eye on the CBAM situation, that they were very keen to utilise this opportunity to raise their price quotations, and they did. But at this point, we still believe that buyers are still able to buy well below the mill's asking levels. But as we get closer towards the end of the year, there is a likelihood that imports will become more restricted. And again, the European mills may have an opportunity to capture the full extent of their price proposals, with possibly more price proposals to come. In terms of our forecast for hot roll coil, which is often the bellwether, I guess, in terms of flat products, MEPS recently downgraded their forecasts, so we're anticipating again a gradual increase for the remainder of the year, possibly by 30 to 40 euros, again with the potential for further increases from Q1 if and when CBAM is fully implemented. So at the moment, that is a downgrade to our previous forecasts, and again that's a symptom of the weak demand situation, high stocks both at mill and service centre level as well. And ironically, the continued presence of imports as people look to buy and beat the CBAM deadline or the quota deadline for the remainder of this year as well. So all that in told, again, scope for slight modest increases for the remainder of the year with the potential for further price hikes next year. That's the situation on coils. In terms of long products, a little bit more modest. Long products in nature do not tend to have the volatility that you see for flat and strip products, and the same rings true for our forecast for the next 6 to 12 months. We're expecting again a gradual modest upward uplift for the remainder of the year, again based on the reasons that we mentioned earlier. But again, the availability of material from local and regional mills, despite production cuts and continued production cuts, is still readily available. So people again can buy what they need very much at short notice, and that will ultimately undermine any price ambitions that the mills have. So again, we expect a positive upward trend, but on a more modest, limited scale.
Okay, Chris, great insight there. Clearly, you continue on a daily basis. I know you're busy at the moment researching for the International Steel Review, and that is the port of call for people to go for more information, isn't it? And all that forecast information, the price indices, and the monthly prices of all products.
Yeah, and I think it's as important now, Tom, as ever, really. I think speaking to market respondents across flats and long products, there is a high degree of uncertainty in terms of procurement, purchasing decisions at the moment, and I'd like to think our customers and clients would use every tool at their disposal to be informed when making those decisions. So I'm sure the ISR and our other associated MEPS products would be of great value to them as they make the most educated decision possible, and obviously trying to mitigate the risks involved, which are very heightened at this point in time.
Great stuff. Thanks, Chris. Thanks for shedding a bit of light on a challenging market.
No, great stuff, Tom. Thank you for the invitation. Great to talk to everyone. Thank you.